As the trading session unfolds, Supermicro Computer, currently trading at $45.18, is up a solid 2.81% for the day. The stock is showing signs of life, a flicker of the momentum that made it one of the market's darlings. But to see this intraday green and assume the old narrative is back in full force would be a critical miscalculation. The expectation from the market has been simple. Supermicro is a key beneficiary of the artificial intelligence doom, a direct play on the insatiable demand for high-performance computing. The reality, however, is far more complex and fraught with underlying tensions that this single day's price action conveniently masks. The story of this stock is no longer a straightforward rocket launch. It's a battle being fought between a powerful secular tailwind and the harsh realities of competition and profitability. Many investors, particularly those engaged in self-investing through platforms like Robinhood or SoFi Invest, saw SMCI as a pure-play AI infrastructure stock, a more accessible version of the NVIDIA stock phenomenon. The belief was that as long as the AI gold rush continued, the companies selling the shovels, like Supermicro, were guaranteed to win. This expectation fueled a meteoric rise, placing it in the same conversations as high flyers like Tesla stock and Apple stock in terms of sheer momentum. But the market has a way of peeling back the layers of a story. The deeper reality challenging this expectation is found not in the daily price swings, but in the company's own financial statements and the evolving competitive landscape. While revenue growth has been nothing short of spectacular, the most recent quarterly report revealed a year-over-year decline in net income. This is the disconnect, the central point of tension that sophisticated investors using platforms such as interactive brokers for their detailed analytics are zeroing in on. How can a company at the heart of the biggest technological revolution in a generation be seeing its profitability shrink? This is where our analysis must go deeper than the surface-level AI narrative. The intraday trading range for Supermicro today, oscillating between a high of $47 and a low of nearly $44 on a volume already exceeding 13 million shares, tells a story of a stock in flux. This isn't the calm, confident climb of an undisputed market leader. It's the choppy, volatile action of a stock where bulls and bears are locked in a fierce debate. The institutional activity has been telling. While many funds have held their positions, drawn in by the top-line growth, there has been an undercurrent of skepticism. The reaction to the last earnings report on August 5th was a clear signal. Despite beating revenue expectations, the stock faltered because the market was forced to confront the reality of margin compression. This isn't an issue. For those managing their portfolios on platforms like Fidelity or considering options like Schwab Intelligent Portfolios, understanding the drivers of profitability is paramount. Supermicro's core business model revolves around its building block solutions, allowing for rapid assembly and deployment of servers customized for specific, high-intensity workloads, exactly what AI data centers require. Their key advantage has always been speed to market, often being the first to integrate the latest and greatest chips from partners like NVIDIA, Intel, and AMD. This agility allowed them to capture a significant share of the early AI server market. However, as the market matures, larger, more established players like Dell and Hewlett-Packard Enterprise are bringing their immense scale, supply chain leverage, and enterprise relationships to bear. This creates a pricing pressure that directly impacts Supermicro's margins. The expectation of easy profits is colliding with the reality of a fiercely competitive hardware market, a sector notorious for its thin margins. Investors using the Fidelity mobile app to check their Fidelity ETFs and Fidelity mutual funds are now forced to ask if SMCI is a high-growth tech stock or a low-margin hardware provider. This is the tightrope Supermicro is walking. On one side, you have the undeniable tailwind of the AI revolution. The demand for generative AI, large language models, and enterprise-level machine learning is not abating. This provides a fundamental demand floor for the company's products. The sector momentum is real. When NVIDIA stock soars, it creates a halo effect for the entire ecosystem. However, On the other side, you have the macroeconomic pressures of a world still grappling with fluctuating interest rate policies and the constant threat of supply chain disruptions. For an individual brokerage account holder, the volatility can be stomach-turning. The stock's journey from its 52-week high above $66 to its current level is a testament to this struggle. The company is, in essence, a high beta play on the AI sector. When sentiment is positive, it soars. When questions around profitability or competition arise, the descent is just as rapid. This is why a simple online investment strategy of buy the AI trend needs to be nuanced. It requires a deeper look into the company's ability to defend its market share and, more importantly, its profitability. The online investing community on platforms like Robinhood, known for its focus on growth narratives, has had to recalibrate its expectations. The availability of Robinhood fractional shares made the stock accessible, but the subsequent volatility has been a harsh lesson in risk management. This isn't a stock for those looking for the steady, predictable growth of a blue-chip dividend payer. This is a battlefield stock on the front lines of the tech hardware wars. So, what does the future hold? The path forward for Supermicro is one of both immense opportunity and significant risk. The primary catalyst remains the unabated expansion of AI infrastructure. As new, more powerful GPUs are released, there will be a corresponding demand for the server and cooling technology that Supermicro specializes in. Their ability to innovate and quickly bring these new systems to market will be their primary weapon. If they can successfully navigate this next product cycle, they could recapture the market's imagination. Analysts have a consensus price target hovering around the $50 mark, suggesting a moderate upside from current levels, a potential that keeps many investors engaged through their SoFi Investing or Interactive Brokers trading accounts. However, the risks are just as potent. The most significant is the looming shadow of its larger competitors. If Dell and others decide to aggressively compete on price to win major cloud and enterprise contracts, Supermicro's margins could be squeezed even further. The company's reliance on key suppliers also presents a risk. Any disruption in the supply of critical components could have an immediate and severe impact on their production capabilities and revenue. This is a crucial factor for anyone considering an investment, whether it's through a Fidelity brokerage account or a more automated solution like an intelligent portfolio. The question for the future is whether Supermicro can transition from being a scrappy, fast-moving innovator into a sustainable, profitable enterprise that can hold its own against the titans of the industry. Do you think the government will pass legislation in favor of the cannabis industry anytime soon? Apologies, that's not the right engagement for this audience. Let's try this. Comment below what you believe is the biggest risk for Supermicro Computer in the next 6 months: competition or margin compression. In conclusion, the story of Supermicro Computer is a perfect illustration of the tension between a powerful market narrative and the granular details of business execution. The expectation was, and to some extent still is, that this is a premier pick-and-shovel play for the AI gold rush. The reality is that while they are certainly selling a lot of shovels, they are doing so in an increasingly crowded and competitive field where profit margins are under constant threat. Today's upward movement is a welcome sign for the bulls, but it doesn't erase the fundamental questions that have caused the stock to pull back from its highs. Investors using a wide array of investing sites and tools, from the sophisticated platforms of Interactive Brokers to the user-friendly Robinhood app, must look beyond the simple AI headline. The path to long-term success for Supermicro will depend less on the growth of the AI market, which is all but certain, and more on its own ability to innovate, scale efficiently, and defend its profitability against much larger foes. The expectation of effortless growth has been met with the harsh reality of hardware economics. How the company navigates this conflict will determine whether the stock reclaims its former glory or settles into a more modest and far more volatile future.